All right, so what do you make of the action that we saw yesterday? I think I want to start off with the small caps hitting another record yesterday. What does that say about the market right now and the fact that investors are going into small caps, what we thought was a catch-up trade, looking for, I guess, gains? What do you think they're looking for there?
I think it's great. You're looking for something cheaper than the mega cap tech, right?
Yeah.
You're looking for something that hasn't moved up yet and finally hitting new record highs after a couple years, just last month. So I look at small caps and there's possibility there. A lot of them are more rate sensitive, a little bit more levered, lower rates help them. And so there's a lot of momentum behind the small caps. We've been burned a couple times with the small cap breakout and then falling behind their large cap peers. But this looks like you have momentum, having a sustained breakout, and small caps may be sticking around to stay, especially if we get another 50 basis points of cuts.
All right. We were supposed to get, I believe, PPI today, but CPI and PPI over these last couple of days. We did get the Fed Beige Book, and it gave us at least a sense of how the Fed's seeing inflation right now. A couple of the highlights, they said tariffs are increasing prices. They also see high-income spenders spending on luxury, medium to low-income spenders really pursuing discounts, the labor market, quote-unquote, largely stable. With that in mind, should we start worrying about inflation and the fact that companies are eating the impact of these tariffs? Because we keep saying earnings are power in this market. I mean, eventually, if companies are eating the tariffs or if they're passing on to consumers, it's going to hurt revenues, it's going to hurt earnings and margins.
Absolutely. We are very concerned on inflation. We look at this. We want stability in tariffs. We want stability in pricing. We don't want this to be passed on, and we're hitting the holiday season, and people may be very surprised how much everything costs. I know you go to the grocery store and you feel it, right? Your basket of goods costs 20-30% more than it did a couple years ago. Inflation is a risk, and it's a risk to margins. We're watching profit margins extremely carefully to see how are they protecting these margins, how are they passing it on to consumers.
Are we overestimating earnings, though? I believe the estimate for this quarter is like 8-9%. I mean, is that an overestimation considering I think we may just be starting to see the impact of tariffs and the president threatening even higher tariffs on China?
The threat is difficult, right? The China threat's a very difficult one because a lot of this is back and forth in negotiation. But I don't think we're at peak earnings, and I don't think we're at peak margins because the growth is there, the revenue growth is there, the spend is there, the consumer is holding up, especially the high-end consumer. You know, look at Louis Vuitton, retorted great results. Looking for Amex to crush it tomorrow morning. Those high-end consumers are spending, and people are continuing to spend on goods and services. United came out yesterday. People want to upgrade. They want the premium seats. Everyone wants the nice lifestyle. Everybody's willing to pay for that. Nobody wants to sit in economy anymore. And you look at those spending trends and realize that revenue growth is there. People are going to spend on technology, upgrading their phones, getting new things that can now be compatible with AI. They need that power. You look at that spend. The consumer right now is the backbone of this economy. Are there concerns that the consumer is going to break with this if we layer on weaker labor, higher inflation? Yeah, that's a concern. But right now, betting against the U.S. consumer has been a really bad bet.
Use the word concern about 7 times. So there are some concerns out there. A lot of headlines about Jamie Dimon and his cockroach comment when it comes to private credit. We're seeing a little tit for tat when it comes to that. I want to talk to you about corporate credit. Story in the FT today about big name investors talking Fidelity and BlackRock. They're actually shorting corporate credit in developed markets, kind of citing that spreads are the tightest or close to the tightest they've been since the Great Recession. We seem to be getting these other little warning signs here and there. Is it time to start piecing these all together? Is this a big warning sign when you're hearing investors like these actually shorting corporate credit in developed markets?
One, I don't think it's a great trade. I think if you're bullish on the U.S. market, you're bullish on the economy, you're bullish on equities, you're going to be bullish corporate credit. Even if spreads are narrow, they're still getting a little bit of pickup over your treasuries. So for me, I look at this as a bit of a confusing trade. Unless you're saying, hey, yeah, we're heading towards a recession, which none of the banks indicated. None of the banks, none of the trading, none of their earnings indicated it. All of them said, hey, our consumer's looking really great. Morgan Stanley, 0 loss provisions, right? So you had multiple banks sitting here saying economy's healthy, and then you're coming out to short corporate credit. I don't really see that as a great trade unless you're seeing something we aren't necessarily. And are these red flags out there? Yes, but there's also a bunch of green flags. It's just how you're going to weigh the green flag versus red flag here. I think there's so many more bullish things driving this economy forward. I mean, you can rave that red flag. You can say tariffs are there, you know, spreads are narrow. There's a lot of comparisons to some of these spreads coming down to 2007. I get that, but I look at that and I say that's not necessarily the data I think is the more important data to weigh.